You're welcome again to this section. This is the second section, which is complementary to the first one. So it is corresponding and continuing from the first session. And here what we are looking at is how do we account for mergers and acquisition. So later in this section, we are going to look at how to account for goodwill and how to calculate goodwill. So we have seen that already in our mergers and acquisition, actually what you are acquiring from the company, besides customers who we cannot translate into money terms, though that could be one of the synergies that you are acquiring a company because it has customers that you need to leverage or to take advantage of. So when you acquire that company, then possibly even the customers will be acquired along, and even some expertise. But here we in accounting we consider money value, so the cash value. That's what we capture in accounting terms in the softwares such as QuickBooks or Tally or any other software that you are using in accounting. So you need to actually identify those assets, and after identifying the total assets, you also need to assess and see that the company has liabilities, so that you get to the proper position of the total liabilities. So remember that here, when you are consolidating financials in mergers and acquisitions, then it means that you are going to bring together the various subsidiary accounts of the subsidiary firms together into a common account, which we call the parent account. So it means that you need to have set up your balance sheet properly, because when the companies are being merged, you're actually merging the balance sheet, because that's where the assets are, the total assets are, and then the total liabilities and the equity. So the balance sheet, we see that the balance sheet has those two parts: the part for total assets, the current assets, and the non-current assets. We call them non-current assets because we have fixed assets and also intangible assets, which assets are not tangible, but they are actually assets of the company. Could be software, could be resources, which are data resources, which actually can be translated into monetary terms. So then the other part is the part for total liabilities. So you need to assess the total liabilities of the company that is to be acquired, so that you get to the true position of the total liabilities, and then afterwards you can also check the equity and retained earnings as equity, and then the retained earnings, so that you have them balancing. So here we are actually following up the international accounts standards, IAS 22, and the IAS's others like 27 and 25 and others. So we're taking an example here where BP is a company acquired, that is the BP company acquired 80% of the shares of SK, paying a consideration of 32,000. This is an example. So at the date of acquisition, SK's balance sheet, this is SK, the balance sheet of SK was, so this is the balance sheet of SK, and this is SK is going to be acquired at 80%. So we want to know what would be the value which is going to be paid, or what we are calling the goodwill. goodwill. So if it is considered, the consideration is 32,000, and now this is now the position of SK before anything has been done on it. So one is going to look at SK and see, yes, non-current assets 25,000, current assets 5,000, the total assets it has 30. Then you look at the other side of capital, and those are capital inputs where we see capital, others call it equity, and the accumulated profits, others call it retained earnings. So we see that share capital 23,000, accumulated the accumulated profit none. So that means that capital is the only one available. Then when you assess the liabilities, they were 7,000, so the total is 30,000. That's the position of SK at the time of acquisition. So the fair value of SK, non-current assets, we have seen it already. We can see that the fair value of is 30 by 30 at that date, and we can also see that the total, we can also see that the total liabilities and equity position is also balancing at 30 there. So to compute goodwill arising from this acquisition, for example here, we can see that if the non-current assets were 30,000, and then we have also set our fair value of consideration at 32,000, then let us assess and see what should we do. So it means that we're going to acquire this SK, the balance sheet of SK. So at acquisition of the balance sheet of SK, we are going to acquire SK, the total, the non-current assets, which we have valued the non-current assets at 30. That is now a valued position. Then you have also assessed that the current assets of SK are at 5,000, so the total assets are 35,000. So the total assets, we are coming here with the current assets. We are picking it, the current assets, right from the balance sheet of SK. So which we see here, the balance sheet of SK, we pulled out the 5,000, and this 30,000 for non-current assets has been just established by assessment. Non-current assets include the fixed assets and then the intangible assets. So for you to come up with 30,000, it means that you need to have done an asset valuation exercise. Outside what is in the balance sheet of SK, you need to go and do this evaluation. If you don't do it and you only end at figures presented to you on paper, then the valuation, then the acquisition is bound to be erroneous or to be full of mistakes. So to avoid that, you do a valuation exercise where you go and you have valuers to look at which type of assets, what's their number, and how far have they depreciated, and what could be their present value, or the net book value. So that you come up here, for it has been established to be 30,000, and the current assets has been established as 5,000. That was picked right from the what? From the balance sheet of SK. And then later on, we see that the liabilities, these are liabilities. So we have the liabilities. We are taking off these liabilities to make sure that the liabilities, okay, when we get total assets minus or less the current liabilities, you have the net assets. So this 28,000 here is the net asset position of SK now. Yes. So you remember now you have 28,000, and then what you have, this is now the value of the company. So if it is to be acquired, one who paid 28,000 and would now have taken the company with or acquired this company without its owners earning anything from it. Not good. There is no goodwill there. Yes, that is called negative or zero goodwill. But then if a person came up and paid, for example, 26,000 instead of 28, that is what you call negative goodwill. It is less than the value of the company. So like the company has been acquired at a loss of the owners. The owners of the subsidiary company which is being acquired are losing money. So that's how that here you set the fair value of consideration to be 32. That's what you say. If we ask someone, how much do you think you can buy this company, or you can acquire the company, and he says at 32,000, then you go and do the evaluation. So then you do the evaluation, then come up and say the value, the net asset value 28,000, but the share of the net assets, these are the share of the net asset is at 80%. So 80% times 28, yeah, so you get 22,400 of the 20 of what 28. So what was being considered as 32, the value of the company has been established. So at least this one is able to have a goodwill arising from acquisition as 9,600, which is the difference between 32,000 up there and the 22,400 shillings. So in a determination of fair value of a specific class of assets and liability, how do we come up with the fair value? Like we say, this company is worth this money. So what we base on are you can be market securities, and these market securities are counted at their current market value. So then there are also non-marketable securities, and those non-marketable securities, their value, this should be valued at the estimated value. You need to estimate them and establish their value. Then the receivables. Receivables, you take them as they are. That's what we call their present value. So what is expected to be received from customers. But sometimes in trade receivables, you can make some discounts. But some others, this is a negotiation platform, because there are some receivables. That's money with your debtors, goods sold on credit. Some of them may not be able to pay. So it depends now on the acquirer and the acquired. They negotiate and see if they are to set a discount to discount bad debts. They can set a discounting of bad debts. But where they don't have a position of discounting bad debts, you keep it as it is at the present value. Then finished goods. So the finished goods should be valued at selling price less the amount of disposal costs and the reasonable profit allowance. So you look at the selling price and take away all the disposal costs that are involved in having the product finished or having the product laid off the shelf. So we also have raw materials. The raw materials are valued at current replacement cost because you have bought them from suppliers at a cost. So at what cost can you replace them? Possibly you resell them at that cost of the supplier, or including freight, the cost that you used to transport to ship these goods from the supplier. You can value them at that. And all those are points of negotiation. Then what we call plant, these are plant or property and equipment. Those ones are valued at the market value, but specifically because there could be, these are depreciating equipment and the property, some of them depreciate. You can also look at the depreciation schedule to see how long when were they acquired and at what value, and what is the depreciation rate per year. So then they are depreciated so that you come up with the net book value. That is the net book value is what you can call the value of the asset after depreciation or amortization. Then payables, you take payables as they are because you don't expect your creditors to reduce for you simply because you're going to be acquired. So the payables remain at their present value of amounts expected to be paid. So you don't need to actually depreciate them. So that is what we have looked at here, so that we can be able to account for acquisitions and be able to calculate goodwill and get to the final results of the goodwill of an acquisition. So thank you for this session. Let us continue to another session. Thank you. Business.